welcome everybody. I am super happy to be here this evening, but back for a one-time only to do a quick tax Q&A. I'm going to jump right into it because I actually got a lot of questions for this, and I want to make sure that I can get to all of them and leave time, hopefully, for those of you who are here live to answer those as well. So just real quick, for those of you who don't know who I am a financial wellness coach. I am a CPA and I'm a certified financial planner. And in my profession, or what I do these days, is I actually have a coaching program that I launched this winter called Find Your Financial Bliss. It's specifically geared for women and couples who are finding themselves with excess cash on hand and feeling like they've tapped out on their wealth building abilities. So I know some of you have asked if I'm accepting clients at this time, and I beyond my individual program, which is actually fully booked right now, I am not able to see individual clients just because of other priorities I have in my life, and because I have all these people in this coaching program that I've created. And for those of you who are curious about this, I know I've talked to some of you about this. A lot of the stuff that we did in the course that I did is incorporated in this, so it might not even be useful to people who attended and came to the course last year. The other thing you need to know is I don't do taxes. I am a CPA. We're here to talk about taxes, but I can't prepare your taxes. That is not what I'm in the business to do, but I am, definitely knowledgeable about this stuff and excited to share what I have to say. So I do need to then issue a disclaimer that this is not tax advice. So anything that I share tonight is for educational and informational purposes only. So if you have a very specific personal situation, I'm not going to be able to help you with that tonight, but I'm definitely here with like all my knowledge and all the IRS resources to help you figure this out for yourself. So I'm not like saying, oh, you don't trust anything, but I want to be clear that this is information and there are going to be nuances. So obviously any interpretation of anything that I offer that might seem a little should probably be run past a paid tax professional. So with that being said, I'm going to go right into the questions. So I actually, let's see, these are all of the questions I got. Whoops. So rather than keep them up on the screen for you to stare at, I'm going to stop this and I'm going to go through them one-on-one so that we can go over these. So let's see, pull up my notes. So the first question that I got that I thought was interesting that I wanted to tackle was, somebody asked, I sold a car and received cash, and do I have to claim that as income? Which is a really great question, because anytime we sell something or we get cash, we think, oh, that's money, I made money. And the way that I would describe this is, I wanted to just take a moment to give an overarching review of what the capital gains rules are. So the IRS calls anything that has value a capital asset. So I'm going to throw some jargon at you, but I want you to, maybe feel a little bit more informed about this stuff after tonight. So when you sell a capital asset, you'll either make money, what they call a capital gain, or you'll lose money, what they call a capital loss, or you'll break even. And with personal assets, personal stuff like our homes, like cars, like clothes, the rules say that if you sell it for more than you paid for it, then yes, you do have a capital gain and you have to claim it as income that would be taxed at special rates. But if you sell it for less than what you paid for it, which is typically the case with a car, you don't have to put that on your tax return. Unfortunately, you don't get to claim a loss, but you, unless you're like a car collector, when you sell your car, if assuming you sold it for less than what you paid for it, no tax consequences there. I should note also, I mentioned houses. If you live in the house for 2 out of 5, the previous 5 years, the IRS classifies that as your primary residence. And there is an exception to having to pay capital gains taxes on profit. So for people who are single, you can make up to $250,000 on the sale of your home, not just selling your house for $250,000, like $250,000 more than you paid for it, without having to pay taxes. And for married people, it's double. So you could make up to $500,000 in profit on the sale of your primary residence and not have to claim that on your taxes. So just a quick overview there on the capital gains rules with taxes. That this is really what this is asking. The next question was, how much does a 401k contribution help or hurt my tax situation? With a follow-up question that was, how much can I or should I contribute? So generally speaking, your 401k is a tax benefit. So the question is, when do you get that tax benefit? So all companies that have a 401k offer you the ability to get an immediate tax benefit, but some companies also give you the choice when you're making contributions to put it into a traditional or pre-tax 401k, kind of like the standard, or they'll offer you the Roth 401k option, or sometimes referred to as post-tax. So if you're not being asked to make a choice when you're deciding how much money to put in, then you just have a traditional or pre-tax. And so when you put money into that type of a 401k through your paycheck, it actually comes out of your check before payroll assesses taxes. So it does reduce your taxes. And that's really good news, right? Especially for people who might be struggling to find a little bit of extra money to save. I always say, like, even 1% of your paycheck might only be like $15. And actually, you can put more in than you think because of that tax deduction. So let's say you decide you're going to do 10% of your paycheck into your 401k. Now your paycheck's not actually going to go down 10%. You're not taking a 10% pay cut. So if your paycheck's $2,000, 10% of that would be $200. So you're going to put $200 into your 401k on payday. If you're in the 22% tax bracket though, that $200 comes out before they figure the taxes on your wages. And so there's actually $44 in federal tax savings. So your check would only go down $156, even though you're putting $200 into the 401k. So that's how the tax savings works. If you have a state income tax, like most of us do, you would also save on those taxes as well. The other side of that is the Roth, where the money would come out, like if in the same scenario, if you're putting 10% in and you put $200 in, that would actually come out after taxes. So your check would actually go down exactly $200 or 10%. The benefit there is that the money, once it goes into the 401k, it's never taxed again. Whereas the typical or traditional 401k is taxed when you withdraw in retirement. So most people would say, I actually, I'm probably going to be making less money, be in a lower tax bracket at retirement, so they would choose to put the money in pre-tax. But some people like to have a little bit of both as well if you have the Roth. So I noticed that there's a question, and I am going to have to save that to the end because I'm not actually totally sure how that question would go, Richard. So I'm going to save that to the end because we'll have to do a little bit of research. So the next question that came in was, and also to follow up, the question was, how much should I or can I contribute to my 401k? So every year the IRS says the maximum amount you can put into retirement accounts. For 401ks, the 2022 limit is $20,500. If you're turned 50 this year or older than 50, then you actually have a little bit more. You can do up to $27,000 because there's a catch-up contribution. So that's the limit. You don't have to put that much in. The one thing to watch out with, if you are looking to put the maximum amount in, which if you can afford to do that, that would be my suggestion. But obviously you want to make sure you can pay your bills and it's not going to put you in debt, and that you wouldn't, you'd be able to survive without that money till you are in retirement. But there is a challenge with making maximum contributions if you have a company that gives you a match and they require you to put money in every paycheck. They base the match on that. So for example, I had my last job said that as long as you put 4% of each paycheck in, they were going to match it. So if I wanted to put the maximum amount of my 401k, I had to figure out how much I could put in every paycheck, so that even on my very last paycheck of the year, I was still putting at least 4% in without going over that limit. So this is a little bit of a hassle, but a lot of companies realize that that's a hassle. And so they're like, you know what, we want our people to put as much money away for retirement as possible. So even if you get the maximum in July, you're going to get the match as if we'll put in 4%, that's the match. We'll put in 4% of the total amount that you put in, even if half the year you're not putting in from your paycheck because you just put in more earlier in the year. That's called a true up. So what does all this gobbledygook mean? If you want to put the maximum in your 401k and you have a company match, you need to double check and ask your benefits people, do we have a true up? The word true, like truth, true up in the 401k. If they say yes, then you don't have to worry about when you get to that maximum. payroll will take care of it. Just put in like, put in 10, 20%, whatever that'll be to make sure you get to that max. If you're over 50 and you want to take advantage of that catch up, that's usually a separate election that you have to make. So make sure you do that. And then beyond that, if you don't have the true up, then there's a little bit of math involved. In terms of how much should I contribute, that is a question that I'm going to answer in March when I do a Retirement 101 masterclass. So save the date for 7 o'clock Eastern, March 15th. We'll talk about actually figuring out how to decide how much you should be saving for retirement, because I recognize that like there's a lot in between zero and maximum amount, right? And a lot of people don't have 401k, so we'll talk about all the other ways you can save for retirement. Okie dokie, keeping an eye on the clock here, because I do want to make this, I know this is going to be available on YouTube afterwards, so you can always go back and listen to this again. I love this question. Is there a dollar amount to shoot for with a tax refund? Ooh, as a tax person, we love this question. The technically correct answer is $0 refund, and maybe even a small balance due. So why would I say that? Because basically, you've probably heard this before, you're giving a free interest-free loan to the IRS. So, when you you're basically prepaying your taxes, you're overpaying, and you could have had that money in your account instead, or, earn interest on it or use it to pay off debt, which paying off debt is kind of a way of earning interest because you're saving on the interest that you were charged on the debt, right? Or for maybe some other lifestyle purpose instead of waiting until spring. But I realize that we are not all able to do what's exactly technically correct. That's why we're humans. So there is a non-technical answer to this question that's going to depend very much on how you operate with money. So for people who have a hard time saving money for whatever reason, but they do have a need to do so for bigger expenses, then having money withheld from your check that you technically more than you technically need to from an IRS rules perspective is one way to kind of force that savings. And because interest rates are so low that you would earn on a savings account anyway, it's kind of like not as huge of a financial impact if it's going to encourage other positive financial behaviors, like using that tax refund to make a lump sum payment on debt. Or my dad, when he was working, always used his tax refund to pay the homeowner's insurance for the year and to pay the car insurance for the 6 months of the year. And he knew that if that money was commingled with their other savings, that it might not be there, because he didn't want to have the hassle of record keeping. Do we have enough in there every month to be accumulating to pay the homeowner's insurance? And that enabled him to pay it in one lump sum and take advantage of the discount the insurance company gave for paying it all at once. So you got to balance out the technically correct answer with your own habits. But I do want to share a quick tutorial on the IRS's rules for withholding, because for those of you who are self-employed or don't have withholdings through jobs, you may have to pay estimated taxes, and this can be helpful to understand how they work and why they work that way. So a lot of people don't realize that before World War II, there actually weren't payroll tax withholdings. Everybody had to, on a quarterly basis, estimate what they thought they were going to owe in taxes for the year and pay in 25% 4 times a year and make those payments. So for self-employed folks or people who have income that's not necessarily job related, or you have multiple jobs and so you're you don't have enough withheld from your checks, that as estimated taxes. It still happens, but if you have a job, that is automatically taken care of you by payroll. And originally that came as just a way to fund the war effort, and then the IRS found that it was much more successful in collecting tax revenue, so of course it didn't go away. But the rule is IRS is a pay-as-you-go system. So they want to have received at least 90% of what your taxes will end up being for the whole year by the end of the year, or by January 15th, which is when the fourth quarter estimated taxes are due. If you can't do that, but you've paid in 100% of what the previous year's taxes were, so let's say this year you have a lot of taxes, you got a big bonus, or you sold something for a lot of money, you made a killing in Bitcoin or something, then you would want to just make sure you paid it in prepaid through payroll withholdings or estimated taxes, at least as much as what your taxes were last year. So you just look at last year's tax return, there's a line for total tax, and it'll tell you that. If you pay in 100% of the previous year's taxes, then you won't have an underpayment penalty. You'll just have a big tax bill on April 15th. But otherwise, most people try to pay in at least 90% of what they ultimately think they're going to owe. So if you have a job, then your payroll naturally figures that out for you, which is really helpful. And that's where we get into the next question about the W-4 form. Filling that out and how you fill that out is really important, because you can manipulate that to have more or less withheld than you might have based on just like the general calculations. So if you, to kind of go back to the original question, which is like, what's the ideal amount? And you want to have like a $0 refund. Actually, the technically correct thing is that you should end up owing exactly 10% of what your total taxes would be. So that's why it's helpful to know these rules. So again, just to summarize, the rules say that you basically have to prepay at least 90% of what your final tax bill ends up being for the year. So if your taxes for 2020 end up being, say, $10,000, which of course you don't figure out till you fill out your tax form and it's too late to prepay, then to avoid the underpayment penalty, you would need to have paid in at least $9,000 ahead of time. So again, most of that happens through payroll taxes or estimated tax payments. And if you don't, then there's just a small penalty and a little bit of interest on what you underpaid. And oftentimes, if it's your first time doing that, you can just like not pay it. And if the IRS comes after you, you could write back and say, I respectfully request abatement of these taxes and penalties because I didn't know any better. And you get a first time ignorance exception usually with the IRS. I wish that worked with speeding tickets, right? Okay, so next question then is about the W-4, because we had a question that said, how many exemptions should I claim when I fill out my W-9, which was, that was the question, but I'm assuming that the actual question was the W-4, which is that form you have to fill out when you start a job that tells them how much taxes to withhold from your paycheck. But you might not know this, there was actually a new W-4 form issued a couple of years ago. In 2018, there was a tax law change that said there are no more exemptions. And so that question is kind of irrelevant because there are no exemptions to claim on a W-4, but let's take a look at the new form so I can kind of walk you through that real quick. So let me just share my screen here. So everything that I am going to show you here is IRS assets. So this is on the IRS website. We have the W-4 form. So you can just literally Google form W-4, but this is the form that you would fill out if you started a job today or after 2018. And if you want to update your taxes being withheld, this is the form you should fill out. And you can see that it kind of walks you through the general questions. Are you married, head of household? And then it actually gives you, it's very specific, but it actually has you just say, if your total income is less than a certain amount, then you would want to put your kids in here. So this step 3 is interesting. The reason they're asking this is if you are a single person who makes more than $200,000 or a married person who makes more than $400,000, you don't get a tax credit for having dependents. And so, but if you do, then this like calculates how much that would reduce your taxable income. If you have other income, like you've got a bunch of savings or you have dividends, you're getting money from, Social Security or 401k distributions, you would put that on line 4A. And then typically, if you're not sure if you're going to be, most people these days are doing the standard deduction, which is, I have to cheat. I got a cheat sheet right behind me. The standard deduction for 2021 is, for single people, it's $12,550, and married filing jointly, it's $25,100. So most people these days are claiming that instead of deductions. But if you have, mortgage interest and taxes and contributions to charities that exceed that, then you put that number here. And literally, from here, if you put nothing else, payroll is just basically going to be like, oh, so based on what you earn, we're going to this is how much you're going to pay in taxes, and they're going to withhold that from your check. If you want more withheld, then you would put that number here. So if you want to have a higher refund, or maybe you have a side gig that you don't feel like paying estimated taxes in, then you could put something in the extra withholding. Maybe you have a spouse that has a a part-time job where like that income alone wouldn't necessarily trigger enough being withheld, this is where you could make sure that you're not underpaying. But generally speaking, if you want to pay less in, then it's kind of really tough to do that with this way this form is formatted, and that was on purpose. So the next thing that I wanted to take then in terms of questions, and I guess I should just check in on the chat here to make sure I'm not missing anything.
Actually, Kelley, Richard had a question and I kind of gave him a short answer as far as I knew, but I think it was something that you should address. And he did repost it. It's in the answered section. You might want to look at that.
Okay.
But it was about money going into a company.
So an estate with a business tax ID that has cash transferred from a personal account. I honestly, that's tax advice. I don't know the specifics and I can't get into the individual information here without like asking a lot more questions. And I have like 7 more questions to answer, but
Sure.
I guess it just depends on the purpose of the estate. If the estate is an ongoing thing and somebody is making an investment, it probably, you could treat it as I don't think it would be income, but it could be a loan or an equity invested. I'm not sure. And then I did see the other comment about like the IRS does give you some leeway if you are struggling to catch up. And I'm going to tackle that here at the end, like what to do if you haven't paid taxes in a while, because that was a question, how do I catch up? And that oftentimes does involve the help of a professional, but I've got some resources for that as well to share. So the question, so just to summarize the W-4, basically, if you want to have more money withheld from your paycheck at this point, then you don't have to do the exemptions thing anymore. It kind of takes the guesswork out of it, the new W-4 form. So you could just ask if your company, depending on the size of your company, if they have something online that they want you to fill out, or oftentimes you can just download it and fill it out yourself and take it to payroll if you work for a smaller company that's a little more paper oriented, if you want to update what's being withheld from your check to increase or reduce your refund. So the next question is really helpful that came in, and I massaged it a little bit. I think I know who it came from, but I wanted to kind of summarize it a little, which is when do I have to file versus foregoing due to a lower income? And is there a reason I might file anyway? That's a great question, because there are reasons that even if you're not required to file your tax return, you might want to anyway. So to answer the question of should I file or do I have to file, the good news is the IRS has a tool for that. And let's see, I have to click it from my notes to show it to you, but it's literally called the Do I Need to File a Tax Return tool. So let me share it with you, and I'll put the link in the chat as well. So basically, this is like a quiz that will ask you your filing status, how much taxes you've had withheld, and some basic questions to determine like whether or not you fall within the thresholds of needing to file. So super helpful tool. Let me just pull up the chat here and put it in there. But literally, you can just search, do I need to file a tax return? And this is the first result that comes up. So the IRS has done some good SEO to get their search results up. But so I'm not going to walk through this tool because it's pretty straightforward and it's pretty personalized. But the other question then is like, okay, what do I need to file? Let's say it says no, I don't need to file. Although I think this would actually help answer that question, even if you don't need to file, but why you might want to. But let's take a look at the biggest reason that you might file, even though you don't have to, is because you might still qualify for a refund. There are a lot of credits out there right now that don't require you to have paid anything into the system in order for you to get a tax credit. Specifically, the one that everyone has been talking about a lot has been the child tax credit and the earned income tax credit. A couple others would be the healthcare premium tax credit. So if you are insured through the healthcare.gov marketplace and you qualify for subsidies, and maybe you didn't get those as part of a premium reduction, you want to file your tax return to get that money back to help pay for your healthcare. So if you, it doesn't hurt to file if you think that typically if you have lower income, you would be in the class of people that often these credits are intended to help. So that would be one reason. Another reason is more for younger people who are still claimed as dependents, or just people who are claimed as dependents on someone else's tax return, but who might have a job that withholds federal taxes. I know my first job was at McDonald's. I worked there for like 3 months out of the year. I started in October. And so they withheld federal taxes. I was 15 years old. Definitely did not need to file a tax return, but I did to get my like $27 back, because I'm not letting the federal government have a penny more than they're supposed to have from me. And the bonus to that, and this would be a bonus to encourage anyone in your life who is a younger person that's working and maybe doesn't need to file, but might get that refund, is I learned how it all worked. So my dad took me to the library and we got the paper forms and he taught me how to fill it out in pencil. And then, so I learned how to read the directions, and he sat there and talked me through it. And then I went through and did it again in pen and filed it. And I learned early on the basics of how tax returns work, so that as my life got more complicated, it was less of a mystery to me. So it might be too late for some of us to start over with that, but that is a good suggestion for people who have dependents who have jobs. And then the other reason that you might file, even though you don't have to, is that filing a tax return actually starts the clock on when an IRS can audit you. So if you've never filed and they don't have any return on file for that, they can audit you on that year until the day you die. Otherwise, they have up to 3 years to do just like a audit for any reason at all, what they call typically an administrative audit. And then after that, if they audit you and they find that you actually would have owed some money or have reason to look in further, they can go back 7 years. So that just filing just makes sure that like when 7 years is gone, you just don't have to worry about the IRS coming and knocking, unless like you've been committing massive tax fraud. And in that case, you should be worried about that all the time. The other question that came up along with this is that if you have state income tax benefits that you'd like to apply for, that you qualify for, that require you to file a state income tax return, you would need to file your federal tax return, because the states start with your federal return, your federal adjusted gross income, basically your income off of your tax return, and then go from there to figure out what you might owe or get a refund from on the state. So to answer the question succinctly, yes, you should file a federal tax return if you want to get benefits from your state for your income and your housing. Okay, so another one of the questions that came in was, if I haven't paid my taxes in years, how do I deal with all of that? And I can't afford to pay that much, but I do want to be current. So this is a tough one, and I knew this would come up when I agreed to do this. And really, it's not an easy answer. So I'm going to show you what the IRS has to say about it. All right, which is basically you should go ahead and file. But it usually would require you getting some type of professional help to file all of the late tax returns. It wouldn't be a bad idea to try to find a tax attorney or somebody who works, especially if you're not necessarily in a place where you can afford to hire an attorney, and this is due to some type of disability or lack of ability to handle your financial affairs. You can usually find resources to help you basically get your records straight, get them filed, and then you would basically go to the IRS and say like, okay, here's all my records, here's all the money that I should have paid in, I can't afford to pay that right now. And they will basically have you fill out your application for extension of time for payment, this right here that I'm highlighting on the screen, form 1127. And The problem is where this can get really, really expensive is when the late payment penalties plus interest just pile on. So usually there comes a time, if there's enough years and enough, late penalties, that you might work with an attorney to make what's called an offer in compromise, where you say, okay, like, I screwed up. I haven't filed my taxes. I actually worked with a client through this years ago. He hadn't filed taxes in like 25 years. So we did have to help him find someone to actually go back and start filing those returns. And then at the end of the day, he had this massive tax bill. And then he went to the IRS and said, listen, like, obviously I can't pay this. Can I pay you this much? And it's like a negotiation. You'd be surprised at how reasonable the IRS can be about that stuff. Their job isn't to be jerks. Sometimes it seems like that, but their job is to collect the tax revenue that U.S. citizens pay through agreement of being a citizen. So that's a lot. I don't have like a person to refer you to if you do work for a company, or you have a spouse, a child, sometimes even a brother or a sister or a parent who works for a larger company. They often have an employee assistance program called a EAP that will often give you access to legal benefits, either at a discount or free consultation with somebody. So if you know someone who's related to you, oftentimes those benefits are extended to immediate family. Ask if they have an EAP that you could call and say, hey, I'm Joe Schmo. My sister works for this ABC company and I need help filing, getting caught up on taxes. Is there a resource for me available? And oftentimes there is, as a part of an employee benefits package. So does anybody else have any, insights on that specific topic? I know some of you may have been through this before.
I don't particularly have insight to it, but quite some long time ago, I was behind on 8 or 9 years worth of taxes, and it was really stressful, as you might imagine. But I don't even know where the person came from, but one way or another, probably because they sent you junk mail, I don't know. But I found a company in Los Angeles, Southern California, that for a very reasonable fee, I had to collect a lot of information and all that, but I gave it to them. They took care of it. They filed it, and I never heard a word from anybody from it, other than the IRS said, you're in good shape. But I didn't get audited or anything else. And I was holding my breath about the audit for that entire statutory period you're talking about, because I really didn't have all the records. I said, well, I think I made this and I think I made that. But and the other thing, actually, the agent was able to get the records from the IRS. So we knew what they had. So, yes. And there were a couple of things they didn't have, and I wanted to get it right. So I added those in, but I'm sure there were things that were happened that just fell through the cracks, but it passed that, whatever it was, 3-year period, and nobody audited me.
That's helpful. That's basically, I've not been through this myself, but that's what I've heard. And just to kind of expound on that point, most of the money that we make, the IRS has a record of us making it. And so they really could do our taxes for us if they wanted to. It's the business owners who do things in cash, or particularly as a business owner, when you have expenses, obviously the IRS doesn't know that those are business expenses versus personal. And so that's where the filing comes in. And then there's charitable donations and there's other things. But like, the IRS knows how much mortgage interest you paid to your bank, because they send the same form that they send you to the IRS. And so, Rick, I'm glad I'm glad the junk mailers got you, because like they know, like, they can pull those records, and the IRS is satisfied that as long as we see what, we know on your returns, they're going to be happy enough that you're just caught up.
There's actually one other thing, if I might.
Yeah.
And that was, I agree with you on the IRS. They just want you to back in the fold. The state governments are, at least California, is entirely different. I actually had a guy knock on my door just about 3 years ago, and he says, well, you earned $31,000 that you didn't report, et cetera, et cetera, et cetera. And I said, what? I pay someone to do some of this stuff, and I easily could have missed something. But it turns out I have a real estate broker's license, which I don't use anymore. And I asked the guy, where'd you get that number? And they basically project that number. So I just said, you mean you made it up? And he says, yeah, we made it up. So you got to question these guys a little bit too. They just said, hey, he's got a real estate broker's license. He probably made the average of 31,000 that people make in California somehow. And they didn't see an entry in it. And, for me, it's a dormant license. I don't use it.
Yeah, but unfortunately, the burden's on you to prove it.
Yeah, well, I actually turned it around. I said, well, show me where I've closed some escrows where you think that I made that money.
Yeah.
Anyway, they just went away. It was, but they knocked on my door. They're paying people to do these things. So it's kind of bizarre.
Yeah, every state has their thing that they, use to try to collect extra revenue, and that makes sense. Okay, I'm going to get back to, there are 2 more questions, and these were goodies. So is it better to hire someone, or is it okay to use something like TurboTax, which is a great question. And we covered this a little bit in my my course, so I'll just kind of give you a little bit of a framework to decide. Generally speaking, if you just have income from like W-2 sources or 1099, like Social Security income, it's pretty easy to do it yourself on TurboTax or H&R Block or any of those online sources. And if your income falls below the IRS threshold levels, you can do it for free through the IRS website, or you can actually go to voluntary income tax assistance programs in your community to actually get your taxes prepared for free. So good idea if you have a lower income to search those resources out. At this point, they should be updated in your community. The best place to look is your local United Way. Just go to their website, look for tax assistance. AARP often has a really great resource on their website that'll tell you where the local places are that you could go and get your taxes prepared for free if you qualify. But otherwise, TurboTax, they literally have invested millions of dollars into technology to make it easy to file your taxes for people who aren't taxed people. So if you have a pretty straightforward situation, then that can be a perfectly okay way to do it. The reason that you wouldn't use those resources is if you're have a small business owner, you're not totally sure if you're keeping your records correctly, or you own rental property and you're not totally sure that you're capturing all of your rental expenses. And also when you work with a professional, then they can help make sure that you're compliant. And if somehow there's something missed, they can help you get back to good. Or if they mess up, then they have insurance that would cover the error. And so you might want to seek out a professional if you're feeling like I just can't get this right. And that kind of leads me to the final question that I received in advance, which is around the child tax credits that came out. So the question was, what if I didn't get the stipend for my kid during the pandemic? Can I get it now, or is it too late? So the good news is, when you file your 2021 tax return, if you use a company like TurboTax, they're going to ask you questions about whether that will help them determine whether or not you qualify. And then they're going to ask you how much you received. And then based on the information that you put in for what you owe, it's going to calculate what you might have gotten if you were supposed to receive the stipend. And yes, you will receive that as part of your refund. Now, if you overpaid, you're going to have to pay that back. So the IRS actually has, again, a website on that. Their website's actually really helpful. So I'll pull it up here. And for those of you who are wondering, I will also put this in the chat for your information. But basically, this will help you, it tells you how you would reconcile it. And basically it just says, if you didn't get all of it, you'll get it in your refund. If you overpaid, you'll have to pay it back. So it will cut into your refund if you usually get one. And then I'm just looking at Rick's comment about the Small Business Association being a good resource for business tax help. I
don't know.
I don't know. They might be a good resource to help you find someone who, they probably know somebody in the community who helps business owners. Yeah. You don't have to work with a CPA to get your taxes done. So that's one thing that often trips people up, is they go to a CPA and they find, if you just Google it, you're going to find all the big firms that charge $3,000. You might also look for an enrolled agent. Those are people who actually have passed a test given by the IRS, who can represent you before the IRS, and oftentimes are a lot more open to working with kind of everyday people like you and me from a tax perspective. It's tough to find a Oh, and I've been putting these chats just to the hosts and panelists. I'm sorry. Let me redo this.
And
So
when I put that in, I actually don't think the SBA would do your taxes by any means, but I think they might very well have, resources for you to go to.
Yes, that's so true. And I'm going to put this back in the chat. They'll probably at least have tutorials on what you might need to know and the like. So those were the questions that were submitted ahead of time, but we have a few more minutes if anything else came up in the meantime. I know Richard did put a good reminder in there that if you find out later on that you qualified for a refund or you realize you overpaid, you can amend your taxes up to 3 years after. That happened to me a couple years ago. I realized I'd forgotten to include a donation of a mattress, which I figured was worth at least $100. And I thought, it's worth the $33 I'll get back to file an amendment. So I did. But I knew how to do it. So maybe that might not be a trigger for most people. And
you answered it, but Kelly, I'm sorry, Tracy had a question back in the stream at 5:10 my time.
Let's go back.
Yeah,
see here.
I don't know if
healthcare deductions. If my family paid for a non-family member's healthcare expenses, might that be tax deductible? So generally speaking, the deduction of healthcare expenses is for people who are dependents on your tax return. So your father paying for somebody else's health expenses would not qualify as a deduction for them, but the person they paid them for could claim a tax deduction if it's high enough. Generally speaking, your healthcare costs have to exceed 7.5% of your adjusted gross income. So if you had like a major, where I've usually seen people write off or be able to deduct medical expenses is if they bought, like retired folks bought hearing aids, or they had like a ramp installed in their home to make it more accessible, or if you had like a major treatment. But generally speaking, it's kind of tough to get a deduction for the healthcare expenses. And that also reminds me of, there are some tax benefit accounts, health savings accounts, flexible spending accounts that you can, through work or through your healthcare, get a deduction for money you put in there and spend on qualified healthcare expenses. Those cannot be used on somebody who's not a dependent. So if you have college kids, or not even college kids, let's say you have a 25-year-old who's on their own, but they're still on your insurance because they don't have a job with great benefits yet. They're allowed to be on your insurance, but you are not able to actually use your HSA or FSA money to cover their expenses. They would have to open their own, which is, for people who want to save money, that's a nice benefit. But oh yes, and Richard just adding to the list of things that would qualify for that healthcare expense that you might be able to deduct: paid caregivers, any type of supplies. So anything that will qualify for health savings account or a qualified medical expense from a flexible spending account perspective would also qualify as a healthcare deduction. So it's just that it has to exceed that 7.5% of your adjusted gross income to be something that you would deduct. Okie dokie. I'm going to take a breath. Any other questions that came in? So I thought, I decided not to make this into like some grand presentation because I just wanted to answer as many questions. I hope this was helpful. And if other questions come up, you can message me through the Mighty networks for Renify members, and I'll do my best to give you an answer. Otherwise, I would say, just to kind of wrap up like where to go for additional answers about this stuff, is the IRS website is actually a pretty decent resource. They've invested resources into making their website more friendly to answering questions so that they don't have to staff phone lines. And so if you go to the help page and they have this interactive tax assistant, there's just a lot there that would be the place to start, because at the end of the day, the IRS is the final authority. Other pretty reliable sources of tax information would be the online providers. TurboTax always has great articles about taxes. H&R Block, they're actually pretty knowledgeable. So those are other places to go if you have questions online.
Excellent.
All
That's
right.
great.
Well, I appreciate you all joining tonight, and especially for those of you who submitted answers ahead or questions ahead of time, so I could come up with some intelligent answers instead of stumbling through like, oh, let me refresh my memory about that. But otherwise, I hope that you've all gotten your tax stuff, and I would say file as soon as you possibly can, so that you can mitigate any possibilities of tax-related identity theft, which doesn't necessarily steal from you, but it can make it very difficult for you to obtain a refund or file your taxes until the IRS has sorted it out. So the sooner you can file, the better. If you are working with a paid preparer, give them stuff ahead of time, even if you don't have all your stuff, so they can at least get things going. They will love you forever for that.
Great.
All right, well,
Thanks, Kelley.
have a good evening. Thanks so much, everyone.
Thank you.